Hello and welcome to the UBP podcast. My name is Peter Kinsella, Global Head of Foreign Exchange Strategy, and today we're going to be talking about the crisis in Lebanon. I'm joined by our Senior Portfolio Manager, Thomas Christensen, and also by our Senior EM Analyst, Kun Chow. So Thomas, I'm going to start with you. What is going on in Lebanon in the bond markets, in the economy, and why are the people taking to the streets in Lebanon?
Thanks, Peter. So I think, first to sort of understand the situation, Lebanon is what I would sort of term a vibrant democracy, but one that has been marred by some policy paralysis over a number of years because of a very fractured government with many different interests. And as a result, the country has been running high budget deficits and had a very significant debt load that has been continuously growing. Now, one attempt to bring this situation under control and bring down the deficit and hopefully get a handle on the debt load was a number of taxes that the government recently announced. One being a tax on the banks, and the more contentious one, at least with the population, has been what's been colloquially referred to as the WhatsApp tax or the social media tax. And this basically sent protesters into the street. And this is something we've seen in a number of EMs recently. But in Lebanon, these protests started as a protest against one specific tax, but has now increased in scope. And now the protesters are calling for a significant host of different changes, fighting corruption, resignation of the government. And yesterday, that's exactly what we got. The Prime Minister Hariri resigned, and at the moment, no caretaker government has been announced. The banks have been closed for almost 2 weeks now and are scheduled to reopen on Friday. But to your question on the bond markets, obviously this has resulted in a significant drop in the prices of the Lebanese euro bonds.
Okay. Kun, you've got a debt-GDP ratio of around 149%, 150%. What can the central bank actually do to sort of make this situation better, or at least to prevent it getting worse?
Well, the central bank has been doing a pretty effective job in the last couple of years by keeping yields high, encouraging banks to invest into these bonds, and ultimately the banks themselves have been attracting foreign depositors, or I should say non-resident diaspora deposits back into the country. So that's been the case for the last couple of years. However, there's a limit to what you can do, and the limits I think were reached this year when, even before these political developments emerged, you had deposit flows had slowed to a trickle, which had led to the problem of refinancing the budget deficit, which had led the government to start thinking about taking deeper cuts to the budget deficit. But that was even before we got to these protests. I think going forward, the central bank in Lebanon will continue to do what it does best, which is to try and reassure locals, will try and manage local currency liquidity and provide support for the banks. But I think the room to do much more is a little bit limited. The thing I want to flag is that the local banks, on behalf of, because of the deposit inflows, the local banks are now holding a very significant amount of Lebanese Eurobonds. The street estimates that local banks hold around $15 billion of Lebanese Eurobonds, which is a lot.
That's quite huge. So in a sense, really, we said during the Eurozone crisis that in Ireland the banks ruined the state, but it seems that in Lebanon the states have ruined the banks. Would you agree with that?
There's certainly resonance in that, and we have this intertwined situation of banks and the state being connected by their exposures.
I see. So we've seen the bond price have dropped a lot, very significantly. The 10-year bond is probably trading at around the 50-point level or thereabouts. So the question is really, when does this become an interesting buy? At what level, Thomas, do you think it makes sense to buy Lebanese debt?
Yeah, that's the $1 million question, I guess. We've obviously been studying the case very closely, continuously, and when we did our debt sustainability analysis, which was predicated on the IMF framework, earlier this year, we found a recovery value that is certainly lower than where the bonds still trade today. So as a result, in our dedicated EM portfolios, we started selling down our exposure. I mean, Kuhn already alluded to the drop in depositor flows that we saw earlier this year. I mean, the one thing that allowed them to carry this high debt load was that they were getting flows into the local banking system that the local banks were then using to buy the Eurobonds and to basically fund the government. When we saw those flows slow down in the first half of this year, we started closing our Lebanese exposures, and we basically got out of the market completely early in the summer, selling most of our exposure in May and the rest of it in the very beginning of July, when the prices are still in the high 70s, low 80s. So where does that leave us today? Well, again, our original debt sustainability analysis had the recovery rate as low as somewhere in the 30s probably. Now Lebanon has a couple of things going for it in terms of the very high willingness to pay, a history of not defaulting, frankly. But the trouble is this situation is now basically spiraling, and I think we have to wait and see when the banks open what kind of a potential run to the banks you're going to see and what that's going to do to deposits, because the trouble is if you have a significant deposit flight and these Eurobonds are getting marked to market lower and lower, the banks and their capital and the solvency of the banks basically gets called into question. They also have good relationships with donors, but ultimately with no government in place able to assure structural reforms that are needed, it's also difficult to see who steps in to back them at this level, and the bond prices are basically dropping every single day. And so I don't think for us it's time to step in, and we don't want to be trying to catch the falling knife on this. Obviously, there is a level at which these bonds will potentially be a buy, or at least where we will slowly add in order to get away from our zero weight and have it just be an underweight as opposed to a complete lack of exposure. But we haven't reached it yet. If I had to draw a line in the sand, I would draw it as low as below 40 cents on the dollar, which is still, you mentioned 50. That's probably maybe the bid at the moment. The bid offers are, of course, very, very wide. But basically, I would say once we get below 40, it could be interesting. But it's also important to track the momentum of this move, and to obviously keep an eye on what's happening on the ground.
And talking about momentum, Kuhn, do you think in this situation can we see a contagion effect to wider EM as a result of what's happening in Lebanon?
I think it's limited. I mean, the economy itself is quite small. GDP is around $60 billion, and across many portfolios, I think people are a little bit cautiously positioned on Lebanon already.
Mm-hmm. Okay, and I think one thing probably worth noting is that over the longer term, when we look at, say, the Eurozone crisis, and what we saw was that the so-called PIGS countries, your Portugal, Ireland, Greece, Spain, etc., people sort of wasted mountains of paper and ink on talking about debt, when in fact, whilst we talked about austerity policies, we didn't really talk enough about reform policies. And austerity basically manages to balance the books, but reform and growth enhancing reforms are really what's required. So if we look at Lebanon, it's a country that in our view at least has tremendous potential. Actually, it's still a very heavily regulated economy, could be deregulated, could be very, very big in agriculture, very big in renewable energy, could be massive in logistics just by looking at the area it's in. So the scope for actual business improvement and indeed a significant GDP uplift is there. The question really though is whether or not we can actually see the government really sort of act to move and enhance and indeed embrace these growth enhancing reforms. But that's about it. So overall, thank you very much indeed for listening, and we'll look forward to seeing you again. Thank you.